One.
Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. Happy Monday. Welcome to the show. We are looking at a week this week that's a little bit more restrained for U.S. economic data. It's certainly a heavy week for earnings, but there is plenty on the calendar that is of interest outside of the U.S., and speaking to the kind of forces that might influence markets writ large and be very, very relevant for U.S. Investors, U.S. markets, global markets writ large, all of the macro assets that we look at, like gold, silver, the dollar, yields. And today, the focus that we have is coming to us from China. We have an interesting set of releases coming out of China over the past several weeks. We'll talk about them here. Today, we get the grand big one. We are looking today to see what's going to happen on the catch-all GDP number. Expectations, as you can see on the screen there, is we are going to move from a 2.9% year-on-year growth rate up to 4%. Now, this is, of course, along with this recovery from the zero COVID lockdowns that we've just started to unwind in China in December. The initial kind of news on when that would begin to be unwound started about December 8th, give or take. And then, of course, we had a sequence of announcements where restrictions were coming off. And so it almost is a given, I would say, that there was going to be some kind of increase in the first quarter because, of course, economic activity, which had been mandated to be effectively crimped to an almost debilitating degree, stopped being mandated thus in that first quarter. And so some level of recovery seems to be inevitable. Where things get interesting is in the makeup. And parallel with these GDP numbers, we are going to get numbers on retail sales, and we're going to get numbers on industrial production for March. And what you're looking at here are the year-on-year growth rates, the GDP numbers, of course, quarterly. These are monthly numbers, but what you see here really extending into March and marking a trend that should color, to some extent, how the GDP increase is achieved is the overcoming of the industrial production and sort of more the export-oriented engine of Chinese growth by the domestic side. The growth in retail sales here expected to significantly outstrip on a year-on-year basis growth in industrial production, suggesting that perhaps what's going on in China is, at this stage at least, being more so powered by the internal dynamics, by domestic demand, than by the export recovery of an economy that really is the sort of value-add center for much of the global supply chain. In broad strokes, China imports a ton of raw materials and applies what is its traditional abundant resource, labor, to turning those things into intermediate and finished goods, and then shipping them on either to end markets in the West or to whatever next step in the supply chain that ultimately gets them to those end markets. And so that's really been the engine of China's immense growth over recent decades is globalization, access to global markets, and this role as a kind of value add center where input products, raw materials, and resources and various inputs begin their journey or advance their journey, depending on the product, toward being finished and sold primarily in Western developed markets. So what you're seeing here is growth powered not by that more traditional engine of Chinese growth, but by domestic demand. And this is, of course, an interesting sort of narrative in its own right at a time when we're concerned about global growth dynamics and that external demand writ large. More on that in just a moment. We can see that recently, the Chinese economic data has had a tendency to outperform relative to expectations. This is Citigroup's Economic Surprise Index. We like to look at versions of this for most major economic releases here on Macro Money. Citigroup constructs this to essentially track when a piece of economic data outperforms baseline expectations that come from surveying of economists and market watchers, and those typically are aggregated by Reuters or Bloomberg or other sort of similar outfits. And helpfully, what Citi also does is it scales the impact of a given data surprise on the index by how reactive markets were to that outcome. And so you have a situation then where this index is not only reflective of the magnitude of surprise, but also the extent to which the markets traded on that and moved on it. And I mean, clearly we can see here that going into this calendar year, data out of China has increasingly surprised on the upside. We seem to have significant vigor here with the reopening of the economy, which you might expect. We had the world's second largest economy in lockdown. There was, of course, a ton of narrative making around this being a major engine of global growth at a time when most global central banks, of course, led by the Fed, have been tightening. And so there's a lot of hindrance to growth. There's a lot of supply chain disruption still. The war in Ukraine is certainly an element in that story. And so China reopening from these COVID lockdowns has been a major source of hopeful expectation for how the global economy might evolve. And looking at the surprise index, we can see perhaps why. And yet, what we notice is that we have a rather strange configuration here for the expected rate structure, where we've actually moved significantly lower on recent yield curves. So you can see the short dash there is the yield curve as compared to a week ago. The long dash is compared to the start of reopening, and we essentially said the beginning of December there to kind of capture the full breadth of when these narratives started to emerge without being too rigid about whether it was the 7th, the 8th, the 5th, the 9th. It sort of depends there. But December was the month, certainly, when reopening began to occur. And so we're looking at the beginning of it as before and sort of the last gasp of the zero COVID regime and the start of when it starts to unravel. And what we see here is since the beginning of December, the yield curve is actually flattened. It's actually come in, suggesting that what we're looking at is a less aggressive, more accommodative setting for the overall policy path, which doesn't seem consistent with an economy that's aggressively growing and seems to speak instead to a loosening of credit conditions, expecting this this recovery to hit the skids at some point. And looking at just the past week, that's against that short dash line, we can see that through the current period out to 6 months, a bit more flattening at the short end, seemingly suggesting that nearer term dynamics in China's economy are a little bit worrying. The back end then steepening back out a little bit to give us very comparable results, but the actual shape of the curve seemingly steepening a bit to imply a little bit of a softness in the immediate term. Why might this be? Well, if we look at the leading PMI numbers, we get much the same story as what the expectations for industrial production and retail sales imply. Notice here, these are the official figures coming out of Beijing government sources, and here you see it's the service sector that's at the forefront, and growth there significantly strong relative to manufacturing. This would again kind of give you the sense that it's primarily a domestically powered recovery that we're seeing for the composite, more so than an external sector-led one. You can see here, of course, in the logic of PMIs, as ever, 50 is the center line, above 50 is growth, below 50 is contraction. When you see numbers above 50, that means the given sector is experiencing expanding activity. When it's under 50, it's contracting. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. And so you can see the numbers for the composite index here as of March, and the service index very close and well above that of manufacturing. These are the official numbers. You're seeing something very similar and perhaps a little bit more dramatic in Caixin PMI numbers, which are an analog survey, but this one from the private sector and essentially powered by S&P Global. Here, what you're seeing, again, clearly a very strong rebound on the service side, a manufacturing side that's not growing at all. That's basically at 50. So in other words, idling. And a composite index that's being pulled higher by services into expansion, but where, again, that seems to be primarily a function of domestic demand. And so the question then naturally becomes, is this sustainable, or is this just restrictions going away and a burst of activity that doesn't necessarily have legs after sort of things normalize with the restrictions gone? One interesting activity indicator that we like to look at is metro traffic in the major cities to kind of give a sense of how normalized is baseline street level economic activity on the mainland. Are people moving back and forth? Are they engaging with the economy at a kind of boots on the ground level? And we can see here, of course, this is by the way, a 20-day average to really capture the trend and get around the noise. What you see here is, of course, we are significantly above the median, so we can see the recovery in traffic. We can see that surge in the back half of last year starting to build, but really in the first quarter here gathering momentum and then stalling. So most recently we can see that big surge in activity seems to have hit something of a wall. Now, that could be, at least anecdotally, suggesting that whatever pent-up activity there was to be had with restrictions going away and people now increasingly braving re-engagement in public spaces, in businesses, in offices, that may be about how much of a pent-up jump there was to have. Now, that could be that it isn't. It could be that there's more here. We've certainly seen this index idle before and then make moves. But it does appear as though whatever big surge there was to have maybe has run its course. And the positioning of this indicator near where we were at this point before the start of COVID, back around levels in late 2019, seems to suggest the initial, at least, lockdown ending premium on activity has been had. And so if we are looking at an economy that's going to be powered by consumer activity returning and powered by domestic demand, one naturally starts to wonder what happens after the first quarter, what happens after this very expected recovery, if in fact the external side of things isn't complying as we see here. The situation gets more worrying still when we look at inflation dynamics. So just last week, we saw Chinese CPI numbers, and they came in softer than anticipated, 0.7% year on year. We can see that when we lag CPI, which is mainly made up in terms of imported commodities of food, energy, and then in terms of domestic elements, housing. Housing, of course, is something that already has seen a bit of an upswing. For overall drivers of CPI, it seems like much of the drift lower from mid last year has been imported. We can see here that when we lag CPI by 4 months here, just to bring reported numbers in line with real-time moving markets, which of course anticipate those numbers inherently, we're looking at a situation where the price of food and the price of energy, here Bloomberg indices on soft commodities and on energy in the dark blue and red respectively here, they were trending lower together. What you see now, though, lining up with this lagged number that we just saw at 0.7, we seem to have reached an inflection point of some sort where soft commodities have diverged. And this is perhaps an element of this reopening in China. Of course, we are talking about the world's second largest economy and the importer of most of the world's top commodities, leading source of demand. So China is the biggest importer of most of the world's raw goods. Certainly soft commodities are no exception, and food is easily a fifth to a quarter of the overall CPI basket. So what you're seeing here is a divergence where energy prices continue going down, but on the food side of things are reaccelerating, and in fact, soft commodities are actually at a higher level now than they were when things were peaking from the latest up move mid last year. This suggests that consumers may actually start to face more of an inflationary environment going forward, that inflation might have bottomed near term in China, or close to it, and might start to recover here as these soft commodity prices echo into food imports, and the consumer starts having a harder time being the source of growth and being the source of demand that powers this economy. We see a bit of that in the way that growth expectations are being put out there by economists. This is from a Bloomberg survey of economists, and you can see here that from December of last year, only a slight increase in global GDP growth expectations, no increase for 2024, modest uptick for 2023. So it doesn't appear as though the markets are assigning a significant premium to China's reopening here for global demand, for external demand. And that perhaps makes sense because this is that engine for China's export side of the economy. This is what would need to pick up the slack if what we're seeing on the consumer side has truly run out of juice or is nearing that point. In fact, it's what one might expect to see. Note here that if we look from about this time 3 years ago, you start getting a build in a global economic activity. These are numbers on total trade volumes in the dark. That's trillions US dollar, and that's from the IMF via Bloomberg here. You can see those numbers going up while rates remain essentially rock bottom. When the Fed starts its tightening cycle, it increases the cost of borrowing on just about everything, every kind of economic activity, because, of course, as we've talked about incessantly on this show, the US dollar remains the overwhelming and unchallenged medium for global commerce, for global transactions. There are no signs that any sort of de-dollarization is anywhere in the cards, despite the ludicrous story making around this narrative seemingly taking hold in markets, as it episodically does in recent weeks. And so what you have here is, with the Fed raising rates and making dollars more expensive to borrow, an increase in the cost of borrowing writ large, an increase in the cost of borrowing everywhere, globally, and that becoming a headwind for economic activity of every kind at every level internationally. And so, not surprisingly, where rates start to go up here, as you can see, the increase in the volume of trade taken collectively hits a wall, and things start to decelerate. So it doesn't look as though we're going to get the kind of external demand story out of China that is going to take over from a consumer domestically that maybe has exhausted all of the pent-up premium that there was to exhaust once the lockdowns came off, and that maybe is looking at a cost structure going forward that'll be increasingly restrictive of demand. And as long as that matches with weak external demand, which seems to be what we're seeing both here and here, we could be looking at a GDP release today that is a sort of buy the rumor, sell the fact kind of a thing, where we get a number, it's an improvement as one would widely expect, and the response from markets essentially is, well, what have you done for me lately? We knew this was going to happen. What are the prospects that China continues to power a rosy view of global growth going forward? If the number today doesn't inspire that kind of confidence, and what we see is an as expected or broadly as expected number, even perhaps a better than expected number to some extent in line with recent economic outcomes. If that's what occurs here, and the market ultimately looks at this and says risk off, and we see weakness in the Australian dollar, which is geared to China. We see weakness in ES futures, which are a kind of broad-based catch-all for market-wide risk appetite. If the yen gets stronger, if the dollar gets stronger, which tend to have a risk-off character, if yields come in a little bit and we start seeing ZT futures, ZN futures, ZB futures catch a bit of support, then that would suggest that a broader risk-off narrative could be taking shape because, of course, much of the story around the recovery in risk appetite, really since the beginning of the year, has been hopeful speculation about what China would add to a soft landing where the Fed is the source of slowdown and China is a mitigating factor. If that mitigating factor is priced out with today's GDP being ruled underwhelming in the context of gathering trends, that would be very, very instructive for where broader markets, U.S. shares, the dollar, yields, precious metals, where all of that is heading. So it'll be a very interesting number indeed to keep an eye on, almost less so for the substance of the release, but more so for what those headline numbers end up producing as a response from price action. And that is Macro Money for today. Thank you very much for joining me. We're here every single week, Monday through Thursday, right after overtime with friend of the show, Chris Vecchio, head of futures and Forex here at tastylive. I'm also on with Chris on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sunday evenings, and opining on Twitter at Ilya Spivak between those shows. Thank you very much once again, everybody. Godspeed out there. See you tomorrow.